Welcome back, Focus Learners. Okay, so today we're diving into a really fascinating explainer centered on Southern Company. They trade under the ticker SO. Now, for literally decades, this has been your standard, hyper-reliable 1945-era traditional utility company. The kind of stock you just buy and forget about, right? But suddenly, it's finding itself smack in the middle of the massive artificial intelligence infrastructure boom. It's a real plot twist.
And that brings us to the core tension we're unpacking today. Is Southern Company a hidden AI play with a massive upside that's just waiting to be unlocked? Or, when you look at that premium valuation, is the market already pricing in all this spectacular growth? It's that classic battle of hype versus financial reality. And we're going to look closely at what the data actually tells us.
So here's our roadmap for this explainer. We're going to start by looking inside Southern Company's core business. We'll dissect their mixed Q2 earnings, and then hit the really exciting part, how they're fueling the AI boom. Finally, we'll weigh out the valuation and the key risks to reach our final verdict. Let's get into it.
Starting off with Section 1, Inside Southern Company. Because look, before we can even begin to understand those massive AI catalysts, we need a solid baseline of what this Atlanta-based energy holding company actually does day in and day out.
Well, first off, their sheer scale is just incredible. Southern Company serves approximately 9 million customers. We're talking massive reach here. They operate heavily across the Southeast U.S. through giant subsidiaries like Georgia Power, Alabama Power, and Mississippi Power. They are an absolute juggernaut in regional energy.
But what really makes this scale interesting is their actual business model. They're a vertically integrated energy holding company, which basically means they do it all, right from the generation to the transmission, and finally the distribution of electricity and natural gas. They have nearly 30,000 employees developing and operating everything from traditional power plants to massive battery storage grids. But here is the absolute crucial takeaway for us. They operate on a state-regulated model with a captive customer base. Now, traditionally, that practically guarantees highly stable, regulated returns on their massive infrastructure investments. But it's also a model that usually puts a cap on explosive, tech-like growth.
Because of that rock-solid stability, they have built an extraordinary track record. Just look at these numbers. 79 years of paying dividends equal to or greater than the previous year. 25 consecutive years of dividend increases. Right now, they're sitting on a current yield of around 3.38%. I mean, it is the textbook definition of a reliable, predictable income stock. I want you to keep this boring stability in the back of your mind as we start layering on the tech-like growth numbers later on.
Moving right along to Section 2, the Q2 earnings mixed bag. To understand where a company is heading, we've got to look at their most recent financial reality, specifically checking out that July 30th, 2026 earnings report.
Let's check out the bottom line to see how their financial picture is building up. And honestly, Southern Company crushed it here. They reported an adjusted earnings per share of $1.13, which easily blasted past the Zacks consensus estimate of just $1.01. That is a massive 22.8% year-over-year earnings beat. In fact, for the first half of 2026, their adjusted EPS reached a very strong $2.46.
However, the top line told kind of a different story. While they beat EPS expectations by almost 12%, their operating revenue came in at $6.98 billion, and that actually missed the $7.36 billion consensus estimate by over 5%. So the million-dollar question is why? Well, this revenue miss was primarily dragged down by notable declines in both fuel revenues and natural gas revenues.
So how on earth did net income still manage to rise to $1.17 billion? It came down to a few really key factors. First, they added over 40,000 net electric customers. They also saw a 2.3% jump in weather-normal retail sales, which, by the way, is their strongest growth through June in nearly 2 decades. Pretty impressive. Combine that with higher equity method investment earnings and lower income tax expenses, and boom, you get a bottom line so strong that management expects full-year earnings to land near the very top of their guidance range.
Okay, this brings us to Section 3, Fueling the AI Boom. This is the hype phase of our explainer. This is exactly why a utility company from 1945 is suddenly dominating the financial headlines right alongside tech giants.
Just look at this number, 55%. In the second quarter alone, Southern Company saw a jaw-dropping 55% year-over-year jump in data center electricity usage. Let that sink in. Their system-wide data center load has now pushed past 1.2 gigawatts. Artificial intelligence requires massive computing power. And those computers, well, they require immense amounts of electricity.
And here is the crown jewel of their portfolio that proves this is definitely not just some short-term blip. Georgia Power, which is a Southern Company subsidiary, signed a landmark 25-year contract with none other than OpenAI to power a 3.2-gigawatt data center near Savannah, Georgia. Phased electric service for this begins in 2028 and runs all the way out to 2053. And amazingly, it actually includes 1 gigawatt of flexible demand response, meaning the data center can dial back its power usage during peak grid stress to help out the system. This is literally the first time the utility has codified that kind of flexibility with a data center customer. It's a real game changer.
And I just love this quote from CEO Chris Womack because it totally validates everything we're seeing in the raw numbers. He told investors that the economic development momentum in the Southeast continues, particularly from these data centers. And he stated firmly, the bottom line is, the load is very real. So guys, this isn't market speculation. This is a tangible, contracted reality.
To support that massive load, their pipeline is expanding incredibly fast. Since the first quarter of 2026, they've added 6 gigawatts of contracts. That brings their total contracted large load to a massive 17 gigawatts across 31 different projects. But wait, it doesn't stop there. They have another 8 gigawatts in late-stage development and a staggering prospective pipeline that exceeds 75 gigawatts. All of this is exactly what justifies their massive $81 billion capital spending plan projected through 2030.
Now let's shift gears back to financial reality in Section 4, Valuation and Key Risks. Southern Company has a market cap of roughly $103.5 billion, trading at around $89.97 a share. We need to figure out if this incredible growth story is already fully priced into that stock.
Looking at Wall Street, consensus has actually cooled down to a hold over the past month or so. While a few major firms like Goldman Sachs remain super bullish and have raised their targets, a larger wave of institutions, we're talking JP Morgan, Morgan Stanley, Truist, KeyBank, have recently lowered theirs. That brings the average one-year price target to roughly $102.29.
And we look closely at valuation. The stock trades at a forward PE of roughly 20.4 times. Honestly, that is quite a premium for a traditional utility. Furthermore, they have a PEG ratio of roughly 6.4 times, which strongly suggests that much of this incredibly exciting AI-driven upside, well, it might already be fully baked into the current price.
Plus, we absolutely cannot ignore the risks here, primarily the debt. Their long-term debt has increased to $68.8 billion. That leaves them with a pretty high 64.6% debt-to-capital ratio. When you're holding that much debt, along with an $81 billion capital spending plan, you become highly sensitive to interest rates. Add in that recent Q2 revenue miss we talked about, along with your standard risks of construction and regulatory delays, and the whole picture suddenly requires a bit of caution. Now, to their credit, management is actively managing this. They recently sourced $700 million in equity to reduce some near-term needs, and they're targeting a 17% funds from operations to debt ratio by 2029.
All right, let's bring all of this evidence together for Section 5, the final verdict.
This setup creates a genuinely fascinating tension for today's investors. On the bull side, you've got this accelerating 55% data center demand growth, a massive 17-gigawatt contracted pipeline, and that landmark OpenAI deal that totally validates their position in the AI space. But on the bear side, you're paying a premium valuation for a company carrying nearly $69 billion in debt, they're facing rising interest expenses, and they had that recent top-line revenue miss.
Which leads us to the general consensus takeaway, hold. At a $100.29 average target, we're looking at about an 11.5% upside from current levels. Look, it's highly attractive for income seekers who want stability and a solid 3.4% dividend yield from a well-managed company. However, if you're hunting for massive tech-style short-term appreciation, that explosive upside appears a bit limited right now simply because the broader market already knows all about these AI catalysts. So, I want to leave you with this final thought to weigh for yourselves based on the data we've covered today. Is Southern Company a buy at these levels, or is the AI story already entirely baked into the price? It's a prime example of how even the most established, traditional companies are being utterly transformed by the demands of the future. Thank you so much for joining me for this explainer. Keep analyzing the numbers out there, and I will see you next time.